commodities. They're rising for a second day today, continuing on their best run this month. How should investors position themselves after the steep sell-off earlier in the week? Frank Holmes, CEO and Chief Investment Officer of U.S. Global Investors, joins us now from San Antonio. His firm's gold and precious metals fund, I should say, is outperforming 90% of its peers this month. Frank, thanks so much for joining us on In Business today. We see gold rebounding from a 4-day sell-off. Is this just a pause in the decline, or is this an inflection point where gold will continue to move on and once again make another run for $2,000?
Well, I think it's a great correction as it runs to $2,000. And I think what's important to recognize is the DNA of volatility of gold. Over the past 10 years, it is a non-event. 70% of the time, gold can rise plus or minus or fall 15%. 70% of the time, it's a non-event to go plus or minus 15%. Whenever it's gone 30%, then you get a big correction. And in August, it went up 40% on a 12-month rate of change. So now we're in that correction mode. And if you take a look at the math of it, it takes it down to where it was the lows yesterday. So I think that it's just healthy going through this process of price correction. Also, what's important is that there's two factors driving this gold: the love trade and the fear trade. The fear trade gets most of the publicity.
The fear trade as people buy into gold because they want to keep their assets safe. They want to preserve some value there, right?
They're concerned about a massive disequilibrium in any government's policies between fiscal and monetary policies. So what we're seeing now in Europe and we have in the U.S., we have negative real interest rates. And you look back over the past 50 years, whenever you've had negative real interest rates, that is, the CPI number in America came out last week, and right now you're losing almost 4% on a treasury bill. Anytime that's taken place, gold starts to perform as a monetary asset class. And people believe that deflation is going to last another couple of years, and thus you're going to have negative real interest rates, and government will not cut back on its fiscal entitlement program, so you're going to see gold trade higher on that fear trade. The fear trade is not only in the U.S., it is also in Europe.
Right.
And in the back of that, you have the love trade. And in many of the countries of the world where GDP growth is 7 to 9%, you have a country that believe in giving gold for the year of this is the year of the rabbit. So you go to Singapore, you can see 24-karat gold rabbits in the window in jewelry stores. You go to India, we're going to be approaching in November the season of lights, the Diwali season. That is usually a big spending period. In August earlier this year, when gold made the all-time highs, we had Ramadan. And we had the fear trade of the debt issues in Europe and in America.
Frank, let me ask you about that love trade, though, because will demand from these emerging markets slow down a bit with gold prices at these levels?
It will, but more significant is the volatility. So anytime gold has a big spike, like we saw recently, then the gold demand basically stops in a short period of time in these countries. As soon as it corrects, like we've had the past 2 weeks, then all of a sudden demand starts to pick up in these countries.
Frank, very quickly here, which gold miners do you like?
What do I like? I like Franco-Nevada. It's a huge profit margin company, pays out monthly dividends, which are higher than a one-year government note. There's no debt in the balance sheet. I like Yamana, also showing growth in production, and a little junior company that's a producer that's got a huge asset base called Gran Colombia.
All right, thanks so much. Gran Colombia, Yamana, and Franco-Nevada. Got it. We've been speaking with Frank Holmes. He's the CEO and CIO of U.S. Global Investors, joining us from San Antonio.